So today we want to understand the business model of a bank, and a good place to start is the balance sheet of a bank. So what you see here is the balance sheet of a typical bank. And this bank has deposits from private people, it has loans from other banks, and it has equity, and has invested this money into financial products and loans. And typically the bank gives less interest to deposits than to its loans, right? This means if you bring your money to the bank, you may get an interest rate of 3%. But if you loan money from the bank may give you an interest rate of 5%. And this difference is where the bank actually makes money. And this is an important building block, or one of the most important building block of the income stream of a bank. And it is called usually the net interest income, right? So this is the difference between the net interest rate that the bank pays on the liability side versus the net interest rate that the bank gains on the asset side. The second building block of a bank's income is typically called the commission and fee income. And this income stream comes from, first, fees that customers pay, right? Maybe you pay something that you can deposit your money at this bank, and from a business stream that is called market making. And market making basically means that the bank creates a financial product that is needed on the market. Think about someone who wants to sell his or her wheat, right? And someone who wants to buy this wheat, but not today, but maybe in 2 months. And what the bank will do is the bank will offer the product to both people, right? But the bank will buy this wheat contract for $95 from person number one. And the bank will sell this wheat product for 105 euros to person number two, right? And this difference is once again where the bank makes money, and this business stream is called market making, right? And the typical third building block of a bank's income is called income from trading, right? And this is what people typically associate with a bank, right? That there's someone who trades maybe shares, maybe the share of Tesla, and buys it at a low price and sells it at a high price, right? So these are the three building blocks for a bank's income. And depending on what type of bank you're looking at, one of these income streams or two of them will be larger than the other. I have once again brought an example, and this is Deutsche Bank. It's the largest bank in Germany, and you see their income or their profit, which is at 2.5 trillion euros. And you see that this income comes from net interest income. This is the difference between the net interest rate from the liability side and the asset side. It comes from net gains or losses from investments in financial products. And it comes from commissions and fees.